to Mr. Jason Wong. Jason?
Good morning, everyone. Thank you for joining me here in this fine Saturday afternoon. So today I'll be mainly sharing about the technology sector, and hopefully after this sharing session, you will have some key takeaways and some good learning points that you can bring home today. So let's move on. Firstly, please take a moment to go through our disclaimer. This is a customary part of all the presentations. Okay, then we'll move on to the main topic. So for technology sector, there are many subsectors. So at IFAS, there are two main subsectors that we particularly like. One will be the digital economy, which we think is a long-term structural mega trend. Okay, the second will be semiconductor sector. Okay, so I believe most of you might have this big question in the mind is, what is digital economy? These are basically companies that derive most of their revenue from the internet. So the birth of the internet, the advent of the internet has given birth to many companies and many new businesses, many new opportunities. And this has created a big economy, mostly digitally. So this digital economy is one of the most exciting subsectors within technology. And it is made out of 8 unique segments, namely e-commerce, e-services, e-travel, digital and social media, fintech, digital advertising, and also cloud services and cybersecurity. So collectively, they are estimated to be worth about US dollars 9.5 trillion today, which is approximately 10% of global GDP. So the next question you might ask is there still potential for the digital economy? So I'll try to give you a top-down view using these two slides over here. So firstly, if you look at the left-hand side chart, okay, this plots the growth of global internet users over the years, and also the growth of the internet penetration rate, which is the number of people using internet divided by the global population. Okay, so in 2020, we actually saw an acceleration of this digitalization because of the pandemic, which actually forced a lot of companies to adapt, to change, okay, and also forced a lot of people to change and change their habits in terms of how they buy their goods, buy their services, and a lot have moved online actually. So if we look at the numbers here, okay, in 2020, the total number of users for internet breached 5 billion. Okay, this is a jump from 4.5 billion in 2019. So about 500 million more internet users. And in terms of penetration rate, the pandemic also accelerated it from a 58.8% penetration rate to 64.2%. In other words, this penetration rate is like out of 100 people, okay, currently there are 64 people that use internet. But on the other hand, there are still 36 people who have not used or touched the internet yet. So there's still a lot of upside potential for the digital economy because there are still a lot of people who have not gone to the internet. And where are all these people? Where's the opportunity? You look at the right-hand side chart here. So how do you interpret this? The orange bars are the current internet users. The blue bars are the non-internet users. And the red dots are the penetration rates for each of the region. So you can see that in terms of number of population, Asia has the biggest number of population. And the penetration rate is only 63%. So there's still about 1.6 billion people in Asia that have not started to use internet. And over in Africa, the population is the second biggest. Okay, their penetration rate is even lower, 43%. And in other words, there's another 780 million old people in Africa that have not used the internet. So most of the potential upside in terms of the internet user growth will come from Asia and Africa, which is why a lot of tech companies are investing a lot to grow their presence in these regions. as you move on to the brighter side of the chart, the other countries, the other regions have already reached quite high penetration rate. Some of them are very saturated already, like Europe and North America, because they are mostly developed countries. So that's why most of the potential for internet user growth will be coming from Asia and Africa. And yeah, that's why as the internet adoption in these regions will likely grow, okay, and they converge closer towards the numbers that we see in developed markets in terms of the penetration rate, the growth in internet and e-commerce will likely follow suit in these markets as well. So the first subsector, just now I mentioned there are 8 subsectors within digital economy, and the first one that I would like to talk about will be e-commerce. Is one of the major ones. So what is e-commerce? These are companies that provide goods and services over the internet, ranging from fashion, furniture, pet products, food delivery, you name it. Okay, as long as they provide the goods and services over the internet. So in Malaysia, the typical e-commerce platforms that you would use are like Lazada and Shopee. Okay, and similarly, thanks to the pandemic, this has actually accelerated the e-commerce around the world. Okay, they are experiencing robust growth. Similarly, for me as well, okay, who would have thought that before the pandemic, okay, who would have thought that I would be buying my groceries or buying my food online on a regular basis? Not really. So before this, I also did less, I would say, less shopping on all this Shopee or Lazada, but because of the pandemic, we are sort of forced to change our spending habits. Okay, and in fact, after we tried all these platforms, it's actually much more convenient and sometimes much cheaper compared to going to the shops. So this trend will likely stay with us, okay, going forward as well. So if we look at the right hand side chart, okay, in 2020, okay, sales of e-commerce hit 4 trillion US dollars, and it's forecasted to grow to 6 trillion by 2023. And this 2020 number was a huge jump from 2019's 3.5 trillion. Okay, thanks to the pandemic. And this growth will continue because people will most likely change their habits, and they realize that this is a much more convenient way to shop as well. And if we look at e-commerce as a percentage of total sales, that means for every $100, okay, how many of it came from the internet? Okay, currently in 2020 it was 15%. Okay, $15 out of 100 is spent through the internet. Okay, so where's the potential over here? In fact, they expect this number to grow to over 20% by 2023. And even 20% is still, I would say, still have a lot of room to grow over in the future. Okay, as we can see, we can take a cue from China. Okay, if we look at China, they are actually the global e-commerce leader, accounting for more than 50% of the market. And if we look at the left-hand side chart over here, in 2014, the e-commerce over the total retail sales for China was slightly over 10% only. But over the years, it has grown tremendously, okay? And the pandemic similarly accelerated this. In 2020, 30% out of all retail sales in China was on e-commerce. So if some of the e-commerce platforms that you know have grown out of this boom in e-commerce from China, and some companies like Alibaba, JD.com, Suning, Meituan, Pinduoduo, so all these have become mega cap large corporations thanks to riding on the consumer boom in China and also the boom in e-com will be US. Currently, they are estimated to command about 17% of the market. And in 2020 also, they saw accelerated growth. Okay, so in 2020, sales from e-commerce hit $788 billion, which is a 32% growth compared to 2019. A huge jump. And if you compare to previous year, the previous year, 2019 growth compared to 2018 was only 15%. So definitely you can say that the pandemic accelerated this. And is there any more potential for the US e-commerce market? If we look at the right-hand side chart, in 2020, it is only 12.5% of total retail sales. In fact, it spiked compared to 2019, which was only 9.9%. And it has grown since the 6.1% of 2014. Okay, in 2020, 12.5% of total retail sales in China, in US, is from e-commerce. Okay, and basically, you can see that this few percentage growth in this e-commerce market has already given rise to all these e-commerce giants like Amazon, eBay, Wayfair. So, is there more potential for this market? If let's say the US starts to catch up to like China's number of 30%, or the global number starts to catch up to China's number of 30%, there's still a lot of potential for e-commerce over there. So here are some of the main e-commerce players that you should know, probably, and probably you will know already. The first one will be Amazon. They are by far the biggest and the market leader in terms of revenue. Then you have JD.com, which is sort of the Amazon of China. So they also similarly have their online platform, and they also offer JD, sort of Amazon Prime version of JD. Okay, JD.com version of Amazon Prime, which gives like which is subscription based, and they give free shipping for the subscribers, and also their access to all the other services such as the iQIYI platform for videos. Okay, so that's JD.com in China. They're actually 17% owned by Tencent, and they're listed in Hong Kong and Nasdaq US. The third one will be Alibaba.com. So Alibaba, you know, like their retail platform will be like AliExpress or Taobao, and they also own Lazada. So they're also listed in Hong Kong and US. And the fourth one will be Suning.com. Then you have Meituan, Rakuten, eBay, Wayfair, Zalando, and Coupang. So these are the main e-commerce players nowadays. And there are other up-and-coming ones on the right-hand side, like Shopify. So Shopify, they are basically a platform, okay, to allow a lot of small businesses to start their online shop or online website easily. Okay, then they've seen a strong growth in business as well, because a lot of businesses were forced to change their tactics rather than focusing on brick and mortar or walk-in customers. They are forced to move online, and Shopify was one of the beneficiaries. Then C Limited as well is listed in US. This one, basically, they are the mother company of Shopee. Okay, then you have Mercado Libre, which is a South American e-commerce platform. So that's for e-commerce. Next, I would like to talk about social media. So what is social media? These are websites and applications that enable users to create and share content or to participate in social networking. Currently, the global population is about 7.5 billion, and about half of them are on some form of social media. Okay, so only 50%. So in other words, you can say there's still a lot of upside for social media. Okay, because a lot of people haven't gone on the internet, and a lot of people don't have social media platforms or presence yet. Okay, so you can see also in the left-hand side chart that this growth has been tremendous over the years, from 2014, from 1.8 billion users, now it's 3.8 billion users, and it's only halfway there. Okay, in the right-hand side table, we can see who are the main social media giants right now. Okay, you can see Facebook currently have 2.7 billion monthly active users. YouTube, 2 billion users. Facebook again, which owns WhatsApp, okay, 2 billion users. Facebook Messenger, WeChat, Instagram, TikTok, QQ, Douyin, Sina Weibo, and so on. So basically these are the main giants for social media right now, and they command a lot of people's eyeballs. So the question is, what can you do with so many eyeballs, which is advertising or ads? And these tech companies, they're so powerful, they leverage on your data. They know what you like to watch. For example, in YouTube, they know what kind of content you like to watch. Then they'll give suggestions of what kind of videos that are similar. And they can give suggestions to advertisers, like if you're targeting certain customer base, then we can target them very accurately because we have the data of what they like to read. So, for example, let's say you like to watch all those investment kind of videos. So you see ads that are similar to that, like talking about investments, a lot of investment gurus trying to sell their investment programs, their courses. So you get this kind of targeted marketing. Then these tech companies also use machine learning and AI to analyze data to show relevant ads to you as well. So let's say you've been shopping around for, let's say, a computer, then you'll probably see ads linking to all this computer website or even Lazada or Shopee. They'll actually show you the things that you're interested in. So it's very powerful. And this way, this is a much better way of advertising compared to the traditional way when you just throw the ads around and hopefully it hits the right target market. So here, they know that what the customers like. They target these customers and they send the ads to them. And the success rate has been much higher than traditional advertising, which is why we see that digital advertising has already surpassed traditional ads in terms of spending. Okay, so in the left-hand side chart, we can see that in 2019, so digital advertisements were over 330 billion, which surpassed the traditional TV, radio, and print or your newspaper ad spending combined. Okay, and this is expected to grow further, okay, to 500 over billion by 2025, which will make up about 70% of the global advertising market. So currently, the dominant players in digital advertising are Google, through the Google search, the YouTube platforms. Then there's Facebook, and Facebook has Facebook, Instagram, and then Alibaba. They also put advertisement on their platform for all those SME or companies to place a big banner in their main page. So they actually charge for that. Amazon similarly as well, and Baidu through Baidu search. Yeah. So these are the main digital advertising companies. Next, I'll talk about software as a service. In short, SaaS. What are SaaS? These are software distribution models where access is provided on a subscription basis via the internet or cloud base. So in the top left-hand chart, this is an example what is SaaS. So in the past, when you wanted to use an application, you need to download it and then install it in your computer before you can run it. But nowadays, you don't really have to do that already. You can just go to the web application of these SaaS services, and you can run it instantly. So some of the examples include like Zoom. You can actually run it through the web, your web browser, Gmail, Google Sheets, WhatsApp, web as well. So these are some examples that most people would use. Okay, so what's the difference is that through SaaS, you can actually access all these applications without installing, and you can access these applications and your data on these applications from any device. So as long as you have a Google account, your Gmail account, you can log in from any device, then you can access your emails, for example. Or WhatsApp, you have your WhatsApp account. You can log in from any device, and you can see your WhatsApp history, the chat history. Okay, so these are some examples for how retailers actually use this SaaS application. But the big money is actually in the enterprises, the companies that actually pay for these services. So if you look at the right-hand side chart, okay, this is the worldwide SaaS revenue growth over the years from 56 billion in 2015, okay, and it hit 144 billion last year, almost triple, and there's still a lot of growth potential expected to hit 250 over billion by 2024. Okay, so some of the leading companies in this space are like Microsoft, Salesforce, and Shopify, which I mentioned just now. So they offer SaaS products through their web cloud-based services. So for example, like Microsoft, in the past, you needed to install the Microsoft Office in your computer. But now Microsoft can actually offer it through the cloud. Then all your files can be saved on the cloud. You can actually do collaboration with your teammates through the cloud. As long as they have access to this file, they can actually work on the same file concurrently, compared to the past where you have to save file, then you pass it to your friend or your colleague, then he needs to do his amendments, then send it back to you. So these are the benefits of doing it through SaaS. Then, like similarly, Shopify, they offer their online shop platform business. Okay, so it's a template for people like even you and me can even go on the Shopify. I want to create a e-commerce website, okay, to sell like kitchen utensils, for example. Then I can just easily, that is templated, I create a name, then it put all my products, add my products, then all the payments systems will all be there. So it's very easy for anyone to even start a e-commerce website, compared to the past where you probably need to hire someone to go and design a website, someone to go and set up all the databases, and someone to link all the payments systems for you, like if you want to allow credit card payment. So Shopify, you can all do it through Shopify. Yeah. So all this I mentioned, like SaaS, or they are all offered through the cloud. Okay. Then other than SaaS, the subsectors that I mentioned just now all also do offer their services through the cloud. The e-commerce platforms like Lazada, Shopee, Alibaba, Amazon, they're all done through the cloud. Okay. Then I also mentioned the social media, Facebook, all this, they're all through the cloud because nowadays everything is moving towards the cloud. So the big question is what is actually cloud? So there are actually a group of servers of data centers around the whole world. Okay. So this is a illustration of one of the data centers. So these data centers, they are not just like one room like that. They are one whole server farms. They are factories or acres of all these servers that you see in this picture here. Yeah. So they store an enormous amount of data. They also give a lot of computing power to all these websites, okay, to run their applications. Okay, and they are dotted around the world and getting more and more right now. Okay, because there's a lot of demand for this. Okay, so who are the ones who are building this infrastructure? These are actually what we call cloud infrastructure providers. Okay, so the big companies will be like Amazon, AWS, Amazon Web Services, Microsoft, Alibaba, Google, and IBM. Okay, so they are the ones that are building all these server farms, these data centers across the world, so that other people can actually tap into their cloud infrastructure. So the benefit from this is that in the past, companies, let's say they wanted to set up their own website, they need to buy their own servers, they need to hire a team of engineers to maintain the server, and it's expensive and it's slow. Okay, nowadays, if you want to just start a website, you can just go to AWS, create an account, then you do whatever you need over there. And if you want to scale, okay, in the past, if you wanted to scale, let's say your traffic has grown, your business has grown, you need to buy another server and add on servers. So now if you want to scale up, you can just buy more from Amazon. Then they immediately can give you this computing power or more data storage immediately because they already built the infrastructure ready. Instantly you can do it. So the people who actually benefit this from a lot are actually e-commerce platforms like Lazada and Shopee. Okay, because they all have for example, let's say they have huge sales day. Okay, like recently, like uh 11/11 sales day. So you see a huge spike in traffic. So under normal situation, if you manage your own data center, you need to cater for this huge spike. You need to have a huge server room. Okay, but if let's say this huge spike is only one time off, after that it's like normal traffic. You don't actually need to maintain such a big server. Okay, so e-commerce platform, they are going towards all these cloud infrastructure providers right now because they are able to cater for all this spike in traffic for short term, and then when it goes back to normal, they'll be just charged the normal rate. So they'll be charged for this spike. Okay, then when the traffic goes back to normal, then they'll be charged the normal rate. So it actually saves them a lot of cost, and they're able to cater for very, very huge volume that is unexpected. So let's say for example, let's say they didn't cater for this huge spike in traffic, then the website will crash. Yeah, so most recently, okay, it's okay. Next. So that is cloud infrastructure. The final slide for this digital economy would be that the digital economy has given birth to a lot of new age internet conglomerates. So in the past, we had conglomerates like Robert Quartz conglomerate that does sugar, palm oil, property, hotel, construction, property development, all these things. So those are the old age or the old economy conglomerates. Now we have the new age, new internet conglomerates, which are huge giants, especially from the US and China, and they have businesses across all the digital economy, like I mentioned just now, e-commerce, social media, digital advertising, and cloud services. So these are the new internet conglomerates that have come out of this internet digital economy. Okay, so some of the examples here like Amazon, Alibaba, Google, Tencent, and Microsoft, and they leverage on their scale, okay, their expertise to branch into other businesses, and they can do it very quickly at cost efficient ways. So for example, uh like like Amazon, okay, they were already an e-commerce giant, okay, so they knew that they needed to maintain a lot of servers and data centers at the back, and they realized that this actually could be a business that could be sold to other people. So they were the first to tap into this, providing all these cloud services, cloud infrastructure to other businesses. Okay, so they already learned from their experience of managing their own servers for Amazon.com, the huge volume spikes, this kind of thing, and they realized that they can actually build data center and sell it to other people. So then came the Amazon Web Services. So uh, they obviously they also use it for their own websites, but in the meantime they also can sell the excess capacity to other people. Another example maybe like Tencent. So Tencent is well known for having a WeChat app where there's a lot of traffic going on in WeChat app. So what they do is that inside the WeChat app, they put in other services as well, so that they can actually tap into their existing WeChat customer base. Okay, so in WeChat, you have all these mini programs. And for example, like they have a partnership with JD.com, which is the e-commerce platform. So what they do is they just put a JD.com mini program. So the WeChat user, when they log in, they go in the homepage, they can actually click to JD.com and go shopping already. Then they also can pay using WeChat Pay. So they are so big, they leverage on their existing reach, their existing expertise also, because they have a lot of tech talents to expand, and they can expand very quickly into other businesses as well. Yeah. So overall, all in all, the digital economy for IFA's research team, we think that there's more than 20% upside potential by end 2023. Okay, so if you look at the trend, basically the pandemic, it was already digitalizing. The economy was already on the verge of digitalizing. It's just the pandemic brought this forward and accelerated this much faster. Okay, like I said, businesses were forced to change, people were forced to change their habits as well, and most likely these habits will actually stay on going forward. So these are some of the numbers. If you would like to see like the table over here, the EPS growth estimates for this digital economy companies, okay, overall, expected to see strong growth in terms of earnings going forward. And yeah, the upside potential is there. So the next sector that we like within the technology sector will be semiconductors, because they actually power all your technology. So I mentioned the growth in digital economy, your e-commerce, your social media, and so on. So what is actually powering these technologies at the back end will be the semiconductors. Okay, so you just look around your room, look around your house. Okay, everywhere there's technology or electronic products like your handphone, your laptop, your TV, your fridge, your aircon is all electronics. And all these electronics, they need semiconductors, definitely need semiconductors inside. And as your products get more and more powerful and smarter, okay, like now you used to have normal TV, now your smart TV with computing power, smart fridge, so on. So there's more and more demand or more and more need for semiconductors in these electronic or technological products. Okay, so in this slide, okay, these are basically where the semiconductors are mainly used right now. So the first one will be communications, like your handphone, computer, consumer products like your PlayStation, then automotive, your cars. Okay, your cars also getting smarter and smarter. Then with the advent of all these electric vehicles, definitely more and more semiconductor parts are needed. Okay, then industrial use also for the automation of a lot of factories. Okay, and next I would also like to talk about what are actually semiconductors. Yeah, some of you may wonder what is semiconductors. So if we look at semiconductors in terms of functionality, there are four main categories. Okay, the first one will be memory chips. Okay, these are typically your RAMs or your ROMs that you probably heard of, and these are chips that store data or programs on your computers and data storage devices. Okay, so they store data. So the main manufacturers or the main creators of all these memory chips will be the Koreans, the Samsungs, and the SK Hynix. Okay, the next category of semiconductor will be microprocessor. Okay, they contain one or more central processing unit CPUs. And for example, you have your Intel, you probably heard of Intel, then you have Intel Core, Intel Pentium, all this. These are the microprocessors. Then they do all the calculations. Then there's another type of microprocessor called graphic processing unit, GPUs, which are the more powerful version of microprocessors. And they actually take on the more in computationally intensive functions, okay, such as rendering from the CPU. So in short, there's another name for this graphics card. So the graphics card are used to do very intensive computations, such as your rendering, when you play video games. Okay, those are very heavy rendering kind of software. And other than that, a lot of cryptocurrency mining also use graphics card because they're used to do very powerful computations. So some of the major manufacturers for graphics chips, okay, are NVIDIA and AMD. Okay, so those of you who play games will know lah. Then standard chips, there's another type, standard chips. So these are also called commodity integrated circuits. Okay, these are simple chips used for performing repetitive processing routines like on and off. Okay, like for example, your remote control, turn on, turn off, or your car, the window you want to pull it up, pull it down. So simple routines, but they also require semiconductors. The last one will be the most advanced system on a chip, SOCs. So these are basically all of the above packed into one chip. Okay, so due to this innovation, we are able to make phones or electronic products much smaller, especially phones. So your phones, like in the past, maybe they needed to put one graphics card, put one CPU, put one memory chip into the phone. That's why you have those big fat phones. But nowadays, they make it smaller. They squeeze everything into one. Okay, their Wi-Fi chip also can be in there. So, for example, like this images that I put here, these are the Qualcomm chips. Probably you heard of Qualcomm chips if you bought Android phones. Then there's the A12 Bionic. This is the Apple A12 chip inside your iPhones. So they're basically a chip that contains all of the above. And these are the most advanced chips and the most powerful. And these are typically made by two companies, TSMC, Taiwan Semiconductor, and also Samsung. Okay, so hopefully you have an idea of what semiconductors are and how are they used in your daily lives. Now the next section is to explain like what does the value chain look like. So from the left hand side to the right hand side, basically the most left hand side will be the higher end of the semiconductor value chain towards the lower end. So it starts from the IC design, integrated circuit design. So they use very advanced software, and all these engineers, they use all this software to draw all these circuits. Yeah, it's very complicated, but this is what's required to do the task that your phones or your laptops require. Okay, so they actually companies like Broadcom, Qualcomm, Nvidia, AMD. Okay, that do the designing of the chips specifically for companies like Apple or this. So they help Apple design the chips. Okay, then they also lease all this intellectual property, such as the chip architecture from companies like ARM, which are owned by SoftBank. Okay, so that's like the base of the chip. They lease this architecture. So, for example, an analogy maybe is like you buy the property from the developer, then this is a standard size and the standard layout of the property. But I would like to do some tweaks based on my preference. Okay, so these are where the Nvidias and Broadcom come from. So the tweaks are mainly to make the chips more efficient. Okay, because especially for handphones, the battery life is very important. So they try to chop off the tasks that or the functions that's not so important or not used. Okay, then they only focus on the things that are the main functions of the phone for the phone manufacturer. Okay, so this way they can actually help to make it more efficient, more power efficient, and save battery life. So for these companies, they typically do not have their own factories to produce the chips. They actually outsource it to foundries. So the fabless companies are like Nvidia, fabless chip makers, Nvidia, AMD, all this. They do the design. Okay, work with whoever their business partner is. They design it for them. Then they outsource the manufacturing to foundries who specialize in just making chips for other people like Taiwan Semiconductor. Samsung, they're also a big foundry player. Okay, in the past because they used to make a lot of chips for themselves. Okay, for their own phones, for their own TV. And because they have all these factories already, they realize that they actually help to make chips for other people as well. So they tap into this foundry business as well. Then there's also another type of manufacturer called integrated device manufacturer, which are like Intel. So they do both. They design and then they manufacture themselves. Okay. So along the manufacturing process, you also need equipment. So all this high-tech equipment they'll buy from companies like ASML from the Netherlands. So they have these big machines that actually do the manufacturing of all these high-tech chips. So once the chip is manufactured, they have these wafers. You still need to turn them into the semiconductor product. This is where the IC and assembly and testing comes in. Okay, so these are where the Malaysian semiconductor companies actually come in. So like Inari, all this, they take the chips, then they add in other components of the other parts of the chips, and it becomes the semiconductor that you can actually use in your electronic products. So they also do the testing after they package the chips, okay, to become the semiconductor product. They do the testing as well to make sure it works. Okay, so after these products are made, they are then assembled into your phones, for example, or your other electronic products, your laptop, all this. So these are where the electronic manufacturing services people come in. Okay, so the most famous one will be Foxconn. Like they do the packaging for Apple. Okay, all your iPhones are made by them. Okay, so they take all these different parts of the phone and they put it together, become your iPhone. Okay, so this is how the semiconductor value chain looks like. And if we think that, okay, technology will continue to boom, okay, semiconductors will continue to boom, the digital economy will continue to grow, which leads to a lot of demand. So semiconductors will definitely benefit, and all the people within this value chain will also benefit. Okay, the part of the value chain is like you can't just do design and then just stop there, because you still need someone to manufacture. You still need someone to assemble it and put it into your iPhones. So that's how the semiconductor value chain looks like. Hopefully you get a better idea. Then the next one will be, what are the drivers for semiconductor demand going forward? Okay, so we believe that we are in a super cycle for semiconductor. Okay, these are the four main drivers that we think that will drive the semiconductor demand for at least the next decade. Okay, the first one will be the work from home or study from home trend. Okay, because of the pandemic. So I believe a lot of you may be forced to work from home right now because of MCO. Okay, and you realize that to work from home, you turn on your old computers, your old laptops, or your old iPad, that they're actually quite outdated and they're not powerful enough to do whatever needed for your work, for example. Okay, then companies who used to use desktop also were forced to change into laptops. Okay, so this actually created a spike in demand for all these new laptops, new electronic products. Okay, and the second driver will be cloud computing. So I mentioned in the previous section that cloud computing is experiencing robust growth. Okay, and companies like Amazon or Alibaba, they're building acres on acres of data centers or server farms like this. Okay, and within all these server farms are all your semiconductor parts. Your servers are all made out of semiconductors. So with the boom of digital economy, the boom in cloud infrastructure, definitely you need a lot of semiconductors to support this. And all this, they actually have wear and tear. They'll actually spoil. They actually turn bad, and you still need to replace them over time. Okay, so the demand from cloud computing will be very strong. Okay, the third one will be 5G. Okay, so now we are also in a 5G super cycle. So in the past we had 3G, now 4G. So you see a lot of phones, people upgrade their phones from 3G to 4G. So similarly now, most people will be upgrading from 4G to 5G as well because of faster internet, low latency, low redundancy. So this now we are also in a 5G super cycle. Okay, so which a lot of people may be very tempted to change their phones because of 5G. Then the next one will be artificial intelligence. So oh, okay, sorry, about 5G also. Other than people upgrading to 5G, 5G also they require more chips inside their 5G products. So expected like 30 to 40% more chips inside the 5G products compared to 4G. So you see a spike in demand from semiconductors from this as well. Then the fourth one will be artificial intelligence. Okay, so nowadays we are all talking about AI, machine learning. So one of the more notable ones will be your self-driving vehicles. So they actually require a lot of computation power to analyze the surroundings, to do the calculations. So this one will require a lot of semiconductors as well. And if AI is going to grow tremendously going forward, definitely it will boost the demand for semiconductors. And yeah, a lot of companies are investing in AI as well to do a lot of things other than autonomous driving. The robo investing also, you need very powerful computers to do the calculations, to analyze the data. Yeah, so these are the four main ones. There are other drivers, okay, like cryptocurrency mining. That one also requires a lot of semiconductors to do the computation. Okay, like similar to like cloud computing, they have server farms just to mine Bitcoin or just to mine all this cryptocurrency. So if this is going to be a trend going forward, definitely semiconductor demand will grow as well. If we look at the right-hand side chart, this is a statistics, okay? The worldwide semiconductor market sales are expected to grow another 10.9% to 488 billion US dollars in 2021 from 440 billion in 2020. So these are estimated by the World Semiconductor Trade Statistics. Okay, so with the growth of semiconductor demand, definitely it will benefit the companies within the semiconductor value chain as well. So all in all, for IFA's research team, we estimate that there's more than 20% upside potential for this semiconductor sector by end 2023. Okay, because the world is becoming more and more tech driven. Okay, this will lead to more and more demand for semiconductors because they are in basically all your electronic products. Yep. Let's see. Okay. The third point will be the tech investment. Okay, so I mentioned about digital economy, semiconductors, and their upside potential. But along the way, it will be bumpy. It won't be a straight line up. Okay, because they tend to be more volatile for tech investment and tend to be more bumpy, but the reward will be worthwhile. We look at some historical anecdotes later. So recently, some of the risks that have arisen, okay, for tech investment include number one, rising yields and inflation fears, which actually sparked a sell-off in March and April recently. Okay, then the second one will be all this government intervention or regulation, such as the Chinese government putting a stop in Ant Financial's record IPO, or they also came in to scrutinize some of the monopolistic practices of all these Chinese tech companies. Recently, also the new U.S. President Joe Biden, he also proposed some capital gains tax on rich people. Okay, so increase of capital gain tax. Sorry, so this actually caused some uncertainty in the markets, especially in tech sector stocks. But I would say, or we would say, don't push the sell button yet. Okay, if we look at historical anecdotes, okay, tech sector typically is more volatile. Okay, and they tend to suffer pullbacks once in a while. Okay, but over the long run, the investors who are willing to tolerate the risk are often rewarded. So in the left-hand side chart, this is the MSCI All Country Information Technology Index quarterly returns since 2011. Okay, so you can see they have had pullbacks over the years due to like most recently last year is the COVID crisis. Then before there's the US-China trade war. Then before there's a Fed tapering fears. Okay, so this is not the first time that the Fed raised interest rates. Okay, so in 2015, tech sector also pulled back because the Fed wanted to pull back on their quantitative easing. In fact, subsequently, they hiked rates 9 times. But after the initial pullback, Okay, you can see that actually they have more than recovered whatever pullback that it suffered from for the tech sector. Yeah. Okay, so pullbacks happen, and this is not first time that interest rate has been raised in the US. Then on the right hand side, we can see that this is not the first time that companies have been fined as well. Okay, so the most recent big case would be Alibaba and the Chinese tech companies. But if you look prior to that, right, like for example, in 2004, Microsoft was fined because they are sort of like monopolistic as well. Okay, because they had so much market share in their Microsoft Windows and Microsoft Office. Okay, and they sort of like force people to it's packaged within their Microsoft Windows, all those applications that people may not need, like Internet Explorer. So the regulators actually thought that this was very kind of abusing their monopoly in software. Okay, so they actually fined Microsoft, but after that, Microsoft did very well as well. Facebook was also fined because of data breaches and so on. Then Google, Apple, all these companies were fined before, but subsequently they recovered and did pretty well. So the main reason that we say that why they still continue to do well and why investors should not be too worried about all these hiccups, okay, is that the earnings and the revenue momentum will likely be very strong going forwards, and this will help to alleviate some of these concerns, okay, as we have seen in the past as well. So in terms of earnings, okay, most recently in the first quarter of 2021, okay, earnings for the companies, the profits for the companies actually exceeded consensus forecast by a lot, okay, because the economy, this is for mainly for US stocks, okay, so because the US economy actually recovered much faster than expected, okay, the vaccination rate there is going on very well, okay, so this actually contributed to the better than expected earnings in the US. Okay, so that's the overall US. If you look at the right hand side chart, okay, 87% of S&P 500 companies reported positive earnings growth, okay, which is a record high, but 94% of tech companies reported positive EPS surprise. Yeah, so 87% of overall companies did better than expected, but tech companies did even better, almost 94%. Yeah. So in other words, what I'm trying to showcase here is that if the economy does well, okay, tech companies will also benefit because, for example, if the economy does well, people have more money to spend. Okay, they have good pay, good jobs, they have more money to spend, then they'll buy more things through e-commerce platform like Amazon. They'll buy bigger ticket items like iPhone. Maybe in the past they only can buy like a Xiaomi like that, but because the economy is doing well, they have more money, they can upgrade to iPhone. They buy bigger ticket items also. Then companies also, if they know that the economy is doing well, they want to grab more of the market share, they'll invest more into advertising. So they'll spend more money to advertise on your social media platforms like YouTube or Facebook. Yeah. Then if digital advertising is doing well, e-commerce is doing well, then they will need a lot of cloud. Yeah. So a lot of companies will also invest to expand their capacity in the cloud also. So if the economy is doing well, the tech sector will also benefit. Okay, so the conclusion, what I'm trying to say through this part is that volatility is part and parcel of investing in tech. With these two recent risks, the rising interest rate, the regulation is probably just a short-term hiccup because the long-term structural trend for tech is still there, right? And we have seen historically that this is not the first time that it's happened. Okay, so in left-hand side chart here, since 2011, okay, the past decade or so, okay, tech in terms of volatility has been higher. Okay, the ups and downs is more volatile than the broader market, but in terms of the return is also much higher. So investors are getting compensated for the risk that they have taken so far. Okay, and on the right hand side chart is the plots the MSCI AC all country world information technology index compared to the broader index. Okay, and in the 9 out of the past 10 years, it has outperformed the broader market. Yeah, so that's all for this part. The fourth part would be fund managers can actually add value when investing in the tech space. So I talked about digital economy, semiconductors, and also the risk or the volatility. So actually, if you find this very daunting task, you can always pass it to the fund managers. Let the professional fund managers do their work. Okay. So for example, how can they add value? Stock selection, so that they can find the best opportunities globally. So all these fund managers, they have so much scale. They have analysts everywhere. So if they want to know what's the latest trend going on in China, they have a team of analysts in China doing that already. So we don't really need to do this kind of work, okay, for retail investors. The fund manager can do it for you, and typically they will have a rigorous fundamental analysis process. So in this example, this is just an illustration of the stock selection process. Let's say there are 2,500 global stocks. Then you want to find companies that derive most of the revenue for internet and commerce. Then you need to screen for all these qualitative uh, criteria like strong revenue growth, profitability, strong balance sheet. So the fund manager will do all this for you in order to find winners, okay, such as Amazon in the past. So if someone invested in Amazon 10 years ago, the total return is more than 1,600%, which is 33% annualized from 10 years ago until now. Okay, so their job is to find all these winners and also future potential Amazons as well, and also to avoid losers. Okay, if you were to buy let's say a ETF that has all the tech stocks inside, it may have the winners and also the losers inside as well, like Yahoo or BlackBerry, for example. So the losers might drag down your overall profit. Okay, then the second point, how fund managers can actually add value, is they can actually pick opportunities from outside the information technology sector. Okay, why I say that? Yeah, people think like, by right, you invest in the information technology sector, you get the full exposure, right? But actually, not necessarily. Okay, one of the reasons is because in 2018 September, the S&P and also the MSCI, they actually underwent a bit of reshuffling of their sectors and the constituents. So what happened was that the information technology sector became so big, okay, because there are so many big companies, all the mega cap companies, the billion and trillion dollar mega cap companies became so big. Okay, then the other sectors became smaller relatively, and the tech sector took up a huge part of, let's say, S&P 500 index or the MSCI World Index. It became a huge part. So it have actually had some liquidity concerns for the other sectors as well. Okay, so what they did is they did this reshuffling. They moved some of these. They created a new sector called communication services sector, which was merged with the telecommunication sector, and they moved some of the IT sector, Facebook, Alphabet, Twitter, Tencent, all this to the new communication services sector. Okay, they also moved some of the like Netflix, which were under consumer discretionary, to the new sector as well. So because of that, right, if you look at the current information technology sector, what's left in there are companies that are offering software services, technology, hardware, and equipment, and also semiconductors. These three segments. Okay, so these are some of the companies under here, like Apple, Microsoft, Taiwan Semiconductors. But where are the Facebooks, the Amazons, the Netflix? They're outside this sector. So if you were to buy, let's say, an ETF that tracks this information technology sector, you may not get the full technology exposure. So this is where the fund manager can come in. They can actually pick the opportunities from the other sectors as well, the high growth opportunities, not only confined to within the technology, the information technology sector that is defined by S&P or MSCI. Okay. The fund manager can also help you to manage single name exposure. So I mentioned just now, some of these tech companies have become so big. Example is Apple and Microsoft. Okay, so if let's say they after the reshuffling, Alphabet and Facebook were no longer in all this tech sector defined by S&P and also MSCI. So Apple and Microsoft became so big, their weight in the index was more than 40%. So if you buy the ETF, almost half of it will be in two companies only, and the others will be much smaller constituents. So what the fund manager can actually do is to help you manage this kind of concentration risk so that you're not overly exposed into single name counters. On the right hand side also as well, the MSCI All Country Information Technology Index, Apple and Microsoft, because their market cap are so big compared to the rest, they command almost 30% of the index. So this could raise some concentration risk concerns. Other than that, okay, the fund manager can also help you diversify geographically. If you were to plot a map, okay, with all the tech companies where they are based or where their main operations are, most of them will be in the US. Yeah, so they're also very big in terms of market cap, which result in a lot of indices if they were to track these indices. Okay, this companies by market cap. Okay, most of it will be in the US. Like for example, the MSCI All Country World IT Index, 85% of the index is US company, but there are actually opportunities outside of the US, like especially in Asia. Okay, you can see in this chart here. Okay, companies like Tencent, Samsung, Alibaba, Meituan. So all these are huge potential companies that are not in the US. So if you were to buy an ETF, let's say that tracks the MSCI AC World IT Index, you will miss out on all these opportunities. So this is where the fund manager can actually come in. So a summary, fund manager can help you do the stock selection, do the rigorous research process for you to pick the winners and the potential winners. They can also go outside of this information technology sector. There could be opportunities in healthcare also, health tech, okay, for example, or consumer discretionary or even communication services as well. Then they help you manage the single name exposure. Let's say like Apple, Microsoft, they're so big or weight, they just underweight it in their portfolio. Then they like Taiwan Semiconductor, they can up the weight for TSMC in the portfolios. And they also can help you diversify globally rather than just follow the index, which is mainly in the US. So currently on our platform, there are 3 retail global innovation and tech funds, which are TA Global Technology Fund, Maybank Global Sustainable Technology Fund. This is a new fund, which is in the investment advisor is Wellington Asset Management. So those of you who have invested in, let's say, the United Global Durable Fund or the United Global Quality Fund would have heard of Wellington Asset Management from the US. Then the third one will be the RHB, Global Disruptors Fund. Okay, it's managed by RHB with the investment advisor of JP Morgan Asset Management. So the first one, the TA Global Technology Fund, is a feeder fund that feeds directly into this Janus Henderson Global Technology Fund. The other 2 are funds managed by the fund house themselves, but they have the global investment advisors to come in and give the stock recommendations, the portfolio allocation recommendations, the entry and exit points for the fund houses. So the first one is a feeder fund, the second and the third one are managed here, but advised by all these global fund managers. Okay, then in terms of Sharia compliance, there's only one that is Sharia compliant. Okay, the third one, which is RHBI Global Disruptors Fund. And in terms of ESG compliance, the second and the third one, the Maybank one and the RHB one, are ESG centric or ESG compliant. Yeah. So now I would like to go through their target fund investment strategy, which could give a glimpse of how different they are. Okay, although they say they are technology, but Some of them have slightly different strategies. Okay, so for TA Global Technology Fund, they invest in companies of any size, okay, which are technology related or derive profits from technology in any country. So they can invest in any size company in any country wherever they find undervalued growth companies where the scale of persistence of earnings growth is underappreciated. Basically undervalued tech companies. And they also like to uncover new and exciting areas of growth such as artificial intelligence. Okay, so that's TA Global Technology. So for the Maybank Global Sustainable Technology Fund, they seek to achieve capital appreciation by investing primarily in a portfolio of global technology-related equities. So it's quite broad. The third one is actually more specific. Okay, they actually invest that integrate both Sharia compliance and also sustainable investing into their investment approach. They employ a bottom-up approach. They focus on innovation from a diverse number of securities within the Dow Jones Islamic Markets World Index. And they believe that long-term growth from earnings and also the likelihood of earnings growth will be delivered by investing in good quality and sustainable companies that can potentially offer attractive and sustainable long-term growth. So by investing, they actually limit themselves, okay, within the Dow Jones Islamic Market World Index. So that compared to the other two, they actually, by only limiting themselves within the securities within Dow Jones Islamic World Index, which are mostly the big cap companies, the mega cap and big cap companies. Okay, so they tend to look for opportunity, to seek opportunity in large addressable markets, complacent incumbents, and secular trends in the market. And innovation, look for innovation new technology which enables better efficiency, choice, and price for end users, and also the acceleration, the potential for rapid adoption and scalability. So these are the things that they look for when they invest. Okay, they are more specific. So this is a summary of their portfolio holdings and their portfolio mix. So we can see that in terms of TA Technology Fund, okay, they are quite top heavy. Okay, about 47.8% of their overall portfolio are in the top 10 companies. I add up the top 10 companies, their weightage, it comes up to 47.8%. So almost half of the portfolio is in the top 10 only. Okay, so quite top heavy. Okay, therefore the rest that are less top heavy, the ones that least top heavy will be the RSB one, only 40.8% of the portfolio in the top 10 holdings. Then in terms of the companies that they hold, actually some are same, but some are different as well. So like for example, like Microsoft, Facebook, these are the same holdings for each of these funds. So all of them also like Microsoft, all of them also like Facebook. Yeah. Then the others are slightly different in terms of the weightage and the stock selection. Okay. Then in terms of fund theme allocation, in the middle, okay, so you can see most of them have semiconductor exposure, okay, which we like also. Okay. Then in terms of the geographical allocation at the most bottom, I would say most of them, they are just now I show you the MSCI AC World IT Index. 85% of the index is in US, so they're slightly underweight. Okay, so like for example, TA Global Technology is 78% in US, so they have slightly more in Korea, China, Taiwan, all these places. Okay, so they underweight a bit on US so that they can increase some exposure into all these Asian tech companies. Then similarly for Maybank as well, Maybank Global Sustainable Technology Fund. Okay, then in terms of the most geographically diversified would be the RSBI Global Disruptor. 57% of the portfolio is in US. Then they have a bigger exposure in China, Taiwan, and so on. Yeah. Okay, then one thing to note is that the RSBI Global Disruptors Fund, they also look for opportunities outside of tech, not necessarily tech, okay, because if you look at the investment approach, these are the things that they look for: innovation, disruptive innovation, this kind of themes, opportunity, innovation, acceleration. So some of the top holdings like Nike is not really tech, but you can say most of their portfolio are tech. Yeah. Okay. So finally, some key takeaways of my presentation. Number one, the digital economy, it is a long-term structural mega trend that is likely irreversible, and we expect more than 20% upside for it by end 2023. Similarly, for semiconductors, if digital economy is going to do well, you need all your semiconductors to power all this technology. Upside potential more than 20% by end 2023. So we have these upside potentials, but the investment journey will be bumpy. Okay, there'll be ups and downs, but history has demonstrated that all these pullbacks happen. Okay, and that investors who are willing to tolerate risk are often rewarded. So in order to manage this volatility, investors can consider like capping a certain amount of their portfolio into tech investments. Okay, not to put in 100% of their money in there, but in terms of overall portfolio, this can be a supplementary, maybe cap it at 20% so that you can manage your overall portfolio volatility. And for investors, okay, so other than doing all the rigorous work of researching yourself, you can always leverage on the expertise and the skill of the fund managers who can add value in terms of stock selection, geographical allocation, portfolio allocation, and so on. Yeah, so that's all from me. Now I would like to take some questions. Okay, so let's see. Got quite a bit of questions over here. Okay. I think I pretty much answered most of the question already throughout the presentation in one way or another. Yeah. Okay, maybe this one. Okay, this is an interesting question. So what's the difference between a technology fund in terms of Sharia compliant and non-Sharia compliant? What kind of sector you pick? I thought all technology fund is Sharia based. Okay, so this is an interesting question. So because I mentioned here, this is the only Sharia compliant fund lah. Sharia compliant tech related fund. So I think more or less most of the companies, the tech companies, would be Sharia compliant, except for a few that probably dabble into like finance, dabble into like fintech, this kind of thing that's not really Sharia compliant. Okay, like some of these fintech companies, let me think. Like Square is a fintech company. Okay, so they do the payments system, but they also give out loans. So this may not be Sharia compliant. So because of that, the Sharia compliant fund may not invest in this. Okay, they actually give out loan and charge interest, this kind of thing. So maybe this will be deemed non-halal for the Sharia committee. So other than that, for Sharia funds, I think the Sharia committee also look a lot on the balance sheet of the company in terms of the profitability, the net gearing ratio, the debt to equity ratio, so that the companies are not overly indebted as well. So they actually put in more rigorous selection process compared to a non-Sharia fund. So in sort of you can think of it in a more positive way. They actually employ a stricter selection criteria, which may actually help the investor give a more peace of mind. Okay, for example, I mentioned the net borrowing, the net gearing ratio, or the debt to equity ratio, the companies cannot be too indebted. Okay, this kind of thing actually can give some comfort to some of the investors, because a lot of tech companies, not a lot, not a lot, but some of the tech companies actually may not be profitable. Yeah, so because of that, there could be huge borrowings as well in order to fund their businesses to grow their revenue strongly. So this may not meet the Sharia committee's criteria. Yeah. Okay. So this one, I hope it answered the question. Okay, I think there's a lot of question about ARC fund, which it's a wholesale fund, so I try not to answer it here lah. So if you have any question, you can ask it through the email to our CIS. Yeah, because it's a wholesale fund. It's only for sophisticated investors. It's not really for the retail general mass market. Yeah. So RHBI Global Disruptor, yes, it is available. All these funds are available. Do you foresee tech semiconductor bubble? Okay, sorry. Do you foresee tech semiconductor bubbles building up right now? What is the difference with the last dot-com bubble that was happened in the past? Okay, good question. So yeah, so I don't think it's a bubble. Okay, not in terms of overall. Okay, there could be some bubbles in certain companies, certain stocks that don't have fundamentals. Okay, but most of the tech companies today are much stronger compared to tech companies during the dot-com crisis. Okay, they're actually generating revenue and generating profits. Let me see. Do I have okay, they're actually generating revenue and profits, and their balance sheets are very strong. They have a lot of cash in their balance sheet as well. So they are very cash rich, like companies like Apple, Microsoft, all this. So compared to in the dot-com bubble, they are much stronger in terms of their financial position right now. There could be some bubbles in some specific counters that don't have the fundamentals, but overall, they're definitely much stronger. So I don't think it's a bubble, okay, because they're backed by all this strong earnings growth, strong revenue growth, and the balance sheet. Okay. What's the difference between investing in the 3 technology funds mentioned and funds like United Global Quality, Kenanga Growth Fund that has a large proportion of investment in tech? Okay, so of course they are managed by different people. Okay, so like TA Global Technology is managed by Janus Henderson, okay, which is a US-based fund manager as well. And the RHBI Global Disruptor is advised by JP Morgan. Then these 3 are mainly tech. So, and their mandate is really focusing on innovation and technology, all this. So for the United Global Quality Fund or the Kenanga Growth Fund, they are more broad-based. Okay, so they can have although currently they have a high weightage in technology, but over time they can change as well. They can change the portfolio allocation more towards finance, more flexible. So for investors, okay, you need to have a core fund, which are this so-called core equity, like United Global Equity Fund, core equity, that can give you exposure to all this broad range of different sectors, a diversified portfolio. Then these technology funds are coming as your supplementary to add on to your existing core portfolio. Yeah. So the difference is all these are really their mandate is really focused on technology or innovation. Those they focus on good quality company, good growth companies, not necessarily in tech. It could be in financials, it could be consumer, it could be industrial materials, for example. So those will be a core that can go across broad sectors. Then you add on supplementary with all these tech-focused, innovation-focused funds. Let's see. Mm, how to define the value? Okay, how to define the value of tech shares because looking at the very high PE. Okay, this one interesting. Yeah, maybe. So I use an analogy here again. So tech companies typically demand a higher valuation or higher PE because they are high quality companies with high growth potential. So for example, let's say you were to buy an asset, would you buy an asset that would you buy a good quality asset with huge potential or high potential at a would you pay a premium for that compared to you buy a low quality asset that has no potential and you pay a cheap price for that? So I think because of that, a lot of people are willing to pay a premium to buy the good quality asset or companies that have good fundamentals and potential compared to paying a cheap price for a not so good company. Yeah. So for example, like Amazon, right? Okay, if you were just to look at PE for Amazon in the past, right, you will never buy it because their PE is like 1,000 over. Yeah, because they weren't really making a lot of profit, sometimes positive, sometimes negative, overall very low profit because they were using a lot of their free cash flow, okay, the cash that they generate from their business, they are reinvesting it to build more so that they can capture more market share rather than uh, so rather than using all this profit to pay out as dividends and buy back all this. So they're using their profits, their cash flow to reinvest in their business to capture more market share, for example, build more data centers around the world, invest in talent, invest in technology so that they can grow even faster in the future. So fund managers actually look through the PE for Amazon in the past. Okay, if let's say retail investor, normal investor, you like PE, the PE is 1,000 over, you wouldn't never thought of buying Amazon. Okay, but fund managers, they look through this, they know that what's the long-term goal of the company. Okay, and they're actually creating profit. It's just they're taking the profit and then investing most of it to grow for the future. Yeah, so hopefully that answers the question. Let's see. Is there any fund that focus on local tech sector, Malaysia tech sector? Okay, so these three funds, no. Okay, they are mainly global. They focus on global. They want by investing in these funds, they actually help you to diversify outside of Malaysia to look for opportunities outside Malaysia because there's still a lot of opportunity outside of Malaysia that you can tap into. But if you want to more exposure in the local tech sector, probably you need to look for the local Malaysia equity funds, like just now mentioned, like Kenangan Growth Fund or CAF Tactical Fund, all this that have their mandate is broad based, but currently they actually have a high weightage in technology sector because of the structural trend that's going on for especially for semiconductors because of most of the Malaysian tech sector companies are actually involved in semiconductor manufacturing. So I think, yeah, so they're typically in number 3 or number 4 in the semiconductor value chain. So they still benefit from the demand for semiconductor, but yeah, so the funds, that's why the Malaysian local equity funds, a lot of them are have higher weightage in the tech sector. In Malaysia would be all these semiconductor companies lah, because 10 out of the top 11 biggest tech companies in the Bursa Tech Index are semiconductor related. Okay. I think, let's see. Are there any tech funds dealing with Bitcoin related companies? Okay. For these funds, okay, directly Bitcoin related, not really, but you can say, in other words, rather than investing in Bitcoin, or this cryptocurrency, you can also indirectly benefit from this so-called boom in cryptocurrency through the semiconductor companies. So I think I mentioned just now that all this Bitcoin mining require a lot of computing, they actually build server farms, okay, to mine Bitcoin. So all these servers require a lot of semiconductors. So indirectly, you can benefit from all this cryptocurrency boom through all this semiconductor exposure, like Taiwan Semiconductor or Nvidia or Samsung or AMD, for example. So hopefully that answers the question. They don't directly invest in Bitcoin, but indirectly you can benefit. Okay. How likely would the tech sector be impacted should the market crash? Okay, interesting. So maybe I can take some cue from last year. So last year, I think during the COVID crisis, so I believe most of you would have noticed that the market did correct quite a bit. Okay, but subsequently, okay, the tech companies were you can say more resilient, and they rebounded faster because their balance sheets are also much stronger. Their businesses actually uh, remain resilient even during this COVID crisis. So yeah, I think they were one of the more positive outcome from the COVID crisis last year. In fact, the COVID crisis retracement. So a lot of businesses were affected, like your hotels, your airlines, all this. So they definitely crashed, and it will take some time for them to come back. Okay, but the tech companies, their businesses are so resilient. It's a with or without COVID, they were already doing well. Okay, with COVID, it actually accelerated their business, and their balance sheets are much stronger because they have so much cash. They're still generating revenue even within COVID. So in in other words, if let's say the crash does happen, yeah, tech sector would retrace. Okay, but if you look at the fundamentals of the tech companies, they're still strong. Yeah, it's actually opens up a good opportunity, just like last year. So if I bring myself back to last year, like I was like looking at the S&P, the Nasdaq, all this dropping like up to 10% one day, close to 10% one day, every day, like that retracement. Then I was looking at it happen, and wow, this is unbelievable, unprecedented, and a lot of tech companies would you would never think that they'll trade at this kind of prices. Like Google was trading at close to $1,000. Now it's 2,000 over bucks already. Yeah. So Amazon was trading, I think, close to 1,700, 1,600 bucks. Yeah. So if you're a you know the companies well, your fundamental analysis, you never before the crisis, you never think that you'll get this kind of prices. Then it happened. Then actually an opportunity to pick up these companies, the good quality companies at such cheap valuations. Yeah. Okay. And I don't think this kind of market crash would happen again. Okay, not until that extent. We may get occasional corrections like 10, maybe 10, 15% kind of correction, but the retracement such as last year, almost like 30, 40%, is very hard to come by already. You need a really big black swan event, okay, to trigger that kind of sell down. So hopefully it doesn't happen again. But if it does, hopefully we'll be more knowledgeable, and we'll actually analyze the situation better, and then just go in. Yeah. a maybe let me take one last question. Actually, most of the question I would have answered throughout the slides already lah. Then okay. So I think that's all for today. Rushi, do you have anything to add on?
Hey everyone, thanks Jason for the presentation. So ladies and gentlemen, that we would like to conclude our webinar today. So thank you everyone for joining today's webinar. If you have any more further questions, you can feel free to email them to our investhelp.my@fansupermart.com. Yeah, and also we have actually prepared a short survey, okay, which will appear in your browser after the webinar ends. So we would appreciate if you can actually take a few minutes to answer this survey. Okay, so thanks Jason, and thank you everyone for joining us in this morning's webinar. Stay safe, and we'll see you in our webinar in next month. For next month, we are actually also planning 2 more technology sector webinars from fund houses. So stay tuned for this event, which we will up on our website soon. Okay, thank you everyone, and stay safe. Goodbye.